Hello, everybody. Welcome to the Mindplex podcast. I'm Lisa Ryan, and we have Ben Gortzel, of course. And today we have Grace the robot and Cloris Chen from Cogito is our guest today. Hi, Cloris.
Hi, Lisa. Hi, Ben. Hi, everybody.
Thanks so much for coming on the show. And I will let Ben take it away. Take it away, Ben.
Well, thanks, Lisa. So what we're talking about today is the Cogito project, which has been incubated within SingularityNet and is now, as we speak, in the process of going out on its own to play its own influential role in sort of the global financial ecosystem. And the bulk of the job of explaining Cogito and what and why it is, and sort of what threads of thinking have come together in forming the unique Cogito project, which is quite different than everything else in the crypto world and in the stablecoin world. The bulk of this job will be done by Cloris, who is the CEO of Cogito, but we'll be discussing and bouncing back and forth a bit on this. And you, I think, Lisa, you can play an interesting role here because both Cloris and I have been neck deep in Cogito for a while, so we probably understand all too well what it's about and may have lost the beginner's mind perspective here. Whereas I think you can be the one asking sort of the basic questions, since stablecoins and fintech isn't exactly your background. And then as we get toward the end of the interview, we can let Grace pose some beginner's questions from a robot point of view. We fed Grace the Cogito white paper, and we can see what AI inquisitions she may come up with based on processing the ideas and text in the white paper. But it's perfect. We have the synthetic perspective on synthetic indexes and cryptocurrencies that are tied to that. But yeah, let's get started by Cloris. Why don't you introduce yourself? Tell a little bit about your own background, and then we can dig into Cogito and its unique take on stablecoins and why we think this has transformative potential for the global financial ecosystem. But first, a little about Cloris.
Sure. Thank you, Ben. So my name is Cloris. So I worked in a bank for 7 years in corporate banking sector. And also I had like 1 year's experience of managing treasury for a fintech company startup. Before leading Cogito for the stablecoin project, I have been very actively investing in DeFi, and that is where my interest is. I also have sort of tech background from taking a master's degree from computer science. So yeah, Cogito is the stablecoin project that we will manage 3 stablecoins, which the stablecoins don't peg the value to the fiat currencies, but instead we will peg to the 3 macro indexes that reflect the environmental, societal, and technological progress of the world. So it's a brand new stuff that nothing else has been built in crypto yet. So very excited to make this happen.
Yeah, I mean the way the idea for Cogito originated was really, I started reflecting on where the cryptocurrency space was at and how the actual tokens out there matched up with the big ideals that cryptocurrency began with, right? Because I mean, obviously, decentralized secure computing can be used for a lot of things besides money, right? And it's sort of a historical fluke that decentralized networks and blockchains began with Bitcoin and digital money instead of, say, with decentralized secure healthcare or decentralized secure theorem proving or something, right? But crypto blockchain did begin with Bitcoin, which is a decentralized money, which is cool. But then the idea of a decentralized money was supposed to be that we have something that's very different than the monies associated with governments and countries with fiat currencies, and be actually useful for all the things that money is useful for, right? So you could have a decentralized, secure alternative to the monies that are issued by countries and governments. And what happened instead? So Bitcoin is launched. Bitcoin is really cool. It's an amazing thing. Now it has a couple downsides in terms of being an actual substitute for U.S. dollar, euro, RMB, ruble, and whatnot. Right? I mean, one downside is transactions are still pretty slow and expensive relative to basic online transactions with USD or something. The other is that the value is incredibly volatile, going up and down a lot on multiple time scales, right? And we can see the longer term volatility right now. Bitcoin is in sort of a slump. We're pretty sure it's going to go way up again. We're not sure exactly when. So being slow, being expensive to transact, and being very volatile in terms of the value, these are all things that make Bitcoin worse than US dollar or euro or Japanese yen, let's say, for basic transactions. So stable coins like USDC, USDT, Paxos, the variety JED, which is on Cardano, the variety of well-known stablecoins out there. These try to address some of these problems, right? So unfortunately, the way the current crop of stablecoins addresses these problems is by pinning their value to a fiat currency like US dollar, and USDC or USDT does a pretty good job of remaining very close in exchange value to US dollar. Now that's practical, it's nice. On the other hand, isn't it sort of against the idea of making a decentralized currency that liberates you from the dictatorship of fiat currencies, right? I mean, you're saying, well, yeah, we know how to make. Yeah, you're saying like, yeah, okay, we figured out how to make crypto more useful for regular financial transactions. We'll make a crypto that's pinned exactly to fiat currency. And I mean, that's useful. And of course, governments know that's useful. And governments one by one are going to be introducing CBDCs, like just central bank distributed decentralized currencies. So, I mean, the U.S. government may itself issue, in effect, a stable coin, which is cryptography based and is pinned to the price of U.S. dollar. Russia can introduce e-ruble, China introduce e-RMB. Then you have a more complex ecosystem where it's less obvious what's the legitimate role for a stable coin, which is sort of privately issued. If governments all have CBDCs that act the same way, but still you're off to the side with all these things of the idea of having something that you can actually use as a digital money, which is not pinned to a government. And why don't you want to be pinned to a government? Well, the government currencies are just manipulated by the government central banks and by all the corporate interests that are playing into the decisions of the central banks. And of course, governments globally are playing all sorts of political games against each other. So that by pinning to one particular government, you're sort of taking a side in those political games. It seems far more in the original spirit of the cypherpunk, crypto pioneers to try to make a digital money that is decentralized, secure, cryptography based, is fast and cheap to transact with, but also is not tied to any fiat currency. But then that brings up the question, okay, well, what does it mean to be stable? Like, isn't the definition of stable pinned to a fiat currency? But of course it isn't, right? I mean, the definition of something being stable to mean that it's not too volatile, it's not going up and down too insanely rapidly, and it's not too easy for parties to manipulate for their own ends, right? And how do you define not going up and down rapidly, if not relative to U.S. dollar? Well, you can define it the same way that they do to estimate inflation indexes or something, right? Like how much does it cost to buy a basket of goods? How much does it cost to buy, a pound of peas, a pound of carrots, a tank of gas, an hour of GPU time, and an hour of phone minutes? How much does it take to buy a basket of goods with 1 unit of your currency? And if the value of a basket of goods in your currency is not fluctuating up and down like crazy, then you have stability. So the definition
highly
of stable
contextual
shouldn't be
with
pinned to a
everything
fiat
else going
currency.
on.
The definition of stable.
Okay.
Yeah.
Yeah.
Yeah, sure. And it's subtle. It's not obvious, right? So like, how do we define it when we say there's been 10% inflation in the last year or 100% inflation over the last few years? I mean, the way economists define that, they create a normalized basket of goods that people might want to buy, and they say, what's the price of buying this basket of goods in US dollar or euro or something? And it's a bit fudgy, right? Because if you're calculating inflation over the last 20 years, the last 50 years, what was the cost of a smartphone 50 years ago? How do you include that in your basket of goods? You don't, right? So I mean there's a bunch of fudginess in how inflation is defined. There's a bunch of fudginess in how stability is defined, and that's just the way it is. There's no hard and fast, totally rigorous, inarguable way to define these things, given the world is changing as much as ours is. Nonetheless, you can do this in a reasonable way, as is done to calculate inflation. Real world economics is fudgy; it's not pure math, right? But there's no reason you can't define tokens that are fundamentally more stable than fiat currencies, because fiat currencies are not maximally and infinitely stable relative to the actual cost of people securing stuff that they want either. I mean, fiat currencies go up and down based on the manipulative decisions of central banks. So anyway, this was the sort of mandate of Cogito, is to create cryptographic tokens that are maintained in a decentralized and secure way using cryptography and distributed computing that are fast, cheap to transact with, and that are fundamentally stable in the sense of not being insanely volatile, and in the sense of not being easy for anyone to manipulate, right? And then within this broad mandate, there's a variety of particular things you can do, which Boris is going to talk more about in a moment. But the core idea is, instead of having a token that's pinned to the US dollar, you create what we think of as a synthetic index. So you create an index.
Right.
You create an index that's calculated based on observations of the world, and these are not observations of money; they're observations of other things in the world. You create an index that's calculated based on observations in the world, and then you want to do some machinations on the back end to make sure that your token's value is proportional to that index. And the fact that you could do this is not a huge mystery. I mean, anyone who's defined an algorithmic stablecoin or a fractionally backed algorithmic stablecoin knows you could try to pin the value of that coin to anything. Mm-hmm. It doesn't have to be a dollar or a fiat currency. People have just made their stablecoins proportional to fiat currencies because it's what everybody else is doing, and people like to copy each other, unless you're crazy people like us who don't like to copy each other and like to do different things. So yeah, let's dig in a bit. So that, Flores, you mentioned for starters, there's three different tokens, three different of this new sort of stablecoin that Cogito has introduced. Each of them is defined by pinning its value to a different synthetic index. So yeah, let's talk about what those three synthetic indexes are and what their properties are.
Right. Thank you, Ben. So the three coins that we're going to do, we start with, let's just say, are called GCOIN. which tracks the green indicators reflecting the environmental progress. Second is S-Coin, which tracks the societal progress. And third one is X-Coin, which tracks the technological progress, reflecting how fast we are achieving technological singularity, etc. So Ben just mentioned a very good point, like how stablecoins should be immune from manipulation, right? Because currently, like when we talk about fiat currencies, it's manipulated by the government, etc., etc. And also, this also relates to being decentralized. And the second point is they need to be stable. So the problems we target to solve the problems here because the three index that we are creating come from the macro data, right? That reflects the genuine development of the human like well-being, technological progress, and also environmental well-being. So no one can control that data, which means, not us, not anybody from the ecosystem can manipulate the data to make the stable coin. They are pegged to three indexes, come from macro data, which cannot be manipulated by anybody, which means the stable coins that are pegged to the indexes cannot be manipulated, right? So it's in nature decentralized, this first. Second, if we look at the past data for the last, let's say, 40 years, according to the model that we have run, let's say green coin that we are talking about, which reflects the environmental progress, has been very steadily trending upwards. There are two things that we need to notice here. First, it's not very volatile. So in nature, it's more steady, which makes it a very good benchmark for stablecoin. Second, it's trending upwards, like in the long term, which means, let's say we are holding fiat-based currency, right? Today is $1, and you can buy 1 carat. The next year, look at the CPI right now, it's 9.1%. Next month, we only buy 0.9 carats, right? However, our token, our stablecoins are tracked to the progress, which moves up, which means simply by holding our stablecoin, you will get natural appreciation. So these are very important features of stablecoins. That's why I think, we are very unique, very original, instead of just copying cat, the other crypto stablecoin projects. Yeah.
Yeah, and so that these different indexes have different properties, right? So if you look at right. The G index of environmental progress, so that the S index of social progress, so these go up and down, but so far, fortunately, they have mostly been going up, but in a sort of slow but steady way, for better and for worse, right? I wish environmental and social progress were going faster. In practice, what happens is they're getting better. They're getting better little by little. So to measure, say, environmental progress underlying the G index, you can look at measures of deforestation globally. You can look at global temperature increase, how it's been palliated. You can look at measures of well-mixed greenhouse gases in the atmosphere. And these measures each year, they are showing slow but steady improvement. So a measure of these things, exactly. It's a synthetic index. It's getting better and better each year. It's not getting better and better much faster. But again, if you're tying the value of a financial token to a weighted average of these environmental measures, what happens is the value will get a little better year on year. Now, if it happened, we make insanely great environmental progress one year, it'll go up a lot. If it happens, we regress environmentally one year because someone starts polluting a lot or something, it will go down a bit. In practice, barring like humongous global changes, these things change a little bit year on year is what happens. And to manipulate that, how would you manipulate this currency, right? Well, you'd have to destroy the atmosphere or plant 100 billion trees somewhere or something, right? It's quite hard to manipulate these indexes except by taking quite dramatic physical actions. Which is very, very different than you can manipulate U.S. dollar. After financial crisis in 2008, Obama, who by and large I think was a quite good president comparatively speaking, but Obama pumped $4 trillion into the U.S. economy, some of it explicitly, some of it implicitly in the back end of the Federal Reserve. Now, he certainly had what he felt was a good reason to do that. He didn't want to be the president who supervised over the collapse of the global financial system. In hindsight, maybe this wasn't the best way to do things. Like, I often think, like, what if you put $1 trillion into AGI research, $1 trillion for nanotech,
that's your answer to everything.
$1 trillion into life extension, $1 trillion, $1 trillion into solving world hunger, right? I mean, you could put $4 trillion into world hunger,
Right.
AGI, longevity, and
the
nanotech.
banks got all that money. Yeah.
But what he did was he put
most of it.
What he did, well, it did boost the economy. It did arguably play a role in preventing the financial crisis being any worse than it was otherwise. But I mean, the point is, anyway, there's one dude, for better or worse, and I'm glad it was him instead of Trump at the time, right? But I mean, there's one dude who could just do that. He could just manipulate the U.S. dollar like that. Now, for the Cogito indexes, even with spending $4 trillion, there's no way you could cause that rapid a jerk in these indexes, because they're measuring really broad indicators of progress on the planet. And the S index, the social index, again, we're looking at global education levels. How many kids can read? How many kids are vaccinated? You're looking at indicators of equality and domestic violence globally, and how much war is happening around the world. So again, if you're measuring all these indicators of global social well-being and sort of averaging them to make an index of human social progress, it's hard to remember sometimes, but we are making overall progress on these social indicators globally. Things do actually get better bit by bit. You can have regress sometimes, but on the whole, these measures that we identify as measuring social progress, sort of according to our current ethical standard, that they're getting better and better, but it's pretty slow, right? And it's distressing.
And who's making the indexes, Ben? Who's doing the indexes?
Well, so what we're doing in Cogito is we define some weights, and then we're just averaging together a bunch of measures that are put out by various NGOs and industry organizations. So I mean, we're not defining the components ourselves. I mean the UN and various subsets of the UN measure things like literacy rates and the amount of domestic violence and the amount of warfare and so forth. For the environment, again, there's various internationally recognized organizations that measure progress toward combating global warming and.
Okay, but Singularity Net is doing those indexes, or is it Cogito?
It's Cogito. So
Cogito.
Yeah. So at the immediate moment, it's Cogito management. So Chloris is is where the buck stops. But I mean, we're launching this as a decentralized project with a governance token. So then
it's transparent how those indexes are calculated.
The holders.
Excellent.
Yes. So the data comes from a third party, like from World Bank, OECD, right? And then our job is we have our economists to build up the model, to define the terminologies and putting a testable model there. And then so that everyone can see the original data because it's publicly available. Second, everyone can view and verify our model because it's also transparent, right? So another thing is just Ben just touched base a little bit is that we also have our governance token we call CGB. So the token holders or stakeholders, so we have not defined on that part, but they will be able to decide like how we want to improve the model, what kind of other composites do we want to include here. So we want to encourage maximal community participation on top of the transparency that we are promising. Yeah.
And so the third coin that Chloris mentioned, which is based on the X index. So this measures progress toward technological singularity. So the ingredients there, rather than being indicators of environmental or social well-being, the ingredients there are things like, what's the speed of the fastest processor on the market? What's the size of the smallest machine that's operational? How much energy does it take to sequence a human being's DNA sequence. So we're looking at indicators of fundamental technological progress of the basic nature that Ray Kurzweil and Mindplex senior editor Amara Angelica worked on in putting together the book The Singularity is Near, that tried to track progress toward technological singularity. So when Ray, with help of Amara, was putting together all these charts showing progress toward technological singularity, I mean they weren't averaging them together to make like a single number of progress towards singularity. They were just looking at, okay, here's the chart of how the fastest processor is progressing. Here's the chart of how much it costs to image a human brain with this amount of accuracy. Here's the chart of how small the smallest working motor is, and so forth. So what we're doing with the X index, we're looking at all those charts of technological progress toward a singularity, and we just have to put weightings on them in a transparent way and average them together, and you get a single number for like how fast are we progressing towards singularity technologically. Now this is a little different than the environmental or social index in that those progress only a little bit year on year. The technological index progresses quite a lot year on year. I mean, for better or worse, that's the kind of world us humans are building. Like we're improving technology a real lot each year, and we're fixing the environment and improving the condition of humanity only a little more linearly. Yeah, maybe exponential, but the exponent is much smaller. Right? The progress is much slower. Now, from a financial point of view, what that means is that the X index, the technological growth index that we're measuring in Cogito, is going up much faster. Now, what that means is that it's going to be harder for our token to track that precisely. So you have a more rapid increase in value there, and you're also going to have a greater volatility there. Because I mean, there's a trade-off in finance between risk and return, right? Or between the speed of increase and the amount of volatility. We're not escaping that. So if someone wants a stable coin that really changes very little year on year, month on month, then the G and S coin from Cogito will fulfill that. If someone's in a business which is very closely tied to progress toward the technological singularity, say a decentralized AI business or genomics business or something, if they're in a business that's very closely tied to technology progress, they may have value for a token that is also tied closely to technology progress. And I mean, then you have the X coin from Cogito, and that's going to go up and down more so, because what you have to do on the back end to maintain compatibility with the X index is a little harder, but it's also, on the whole, in the longer term, it's going to track the progress towards singularity. So launching these three, it's a little bit arbitrary. I mean, you could have 1, 2, or 10 tokens, but we think this is it's a good place to start, and there may later on be more tokens in the family here.
So I think we talk about starting with 3 stable coins, but actually what we are doing is creating a prototype. Basically, we want to define this kind of model, and then what kind of coins will be created is completely subject to the community's desire and then the user's needs. So it's a demand driven. What we want to do is to make sure that the model works, the design works, and our mechanism works.
Yeah. So let's at risk of numbing or blowing the minds of the less quantitative members of the audience,
like me,
let's talk a little bit about the difference between, so in the scheme of stablecoins, you've got fully backed stablecoins, you've got purely algorithmic stablecoins with no backing, and you've got fractionally backed stablecoins. So let's talk a little bit about what each of those is for people who don't know. Then we can talk about what happens when you design an algorithmic stablecoin badly, as
and why
we've
we're
seen
not
with
doing it that way.
some
Yeah.
rather large issue.
Yep.
Yeah.
Yeah,
As we've seen in the
exactly.
crypto world recently. Yeah, but maybe you can clarify for Lisa and the others without a banking background, sort of how these three kinds of stablecoin work.
Sure, no problem. So yeah, in terms of stable coins, we always have like broadly three categories. The first one is we call fiat based. So the common ones, let's say USDT, USDC. What they are doing is users place US dollar in their bank account, and then they bring the money in on change USDC or USDT. So it's one-to-one fiat based. The strength of them is like you can see they are well backed, right? So you can be redeemed one-to-one in terms of the security. However, there are risks there. So first of all is the transparency, because USDT is issued by Tether and USDC is issued by Circle. So we don't know what they are doing on the back. Yes, they do have disclosure on quarterly basis or monthly basis, but no one is able to verify. So what do they do with the US dollar? Do they really place the money into their bank account, or are they using any of the US dollar savings for other high risk investment? We don't know that. So there has been rumors. I mean, and also especially during bearish market where people are very risk off, there are always rumors about how USDT might be pegged, etc. This is a very big problem here. Secondly, is this kind of stable coins, they are very centralized, right? So you are relying on one entity to ensure the security of the token, and then you have to, for whatever you do, they might be, let's say, in the very extreme case where one of them might be cracked down, and then the entire system will break down, right? So this is the downside of this kind of fiat based stablecoin. Second one we call they are also fully cash based, but we sometimes use commodities or like crypto assets. So there are several representatives here. The most famous one is called DAI. So DAI is backed by a basket of crypto assets, right? So the problem with the crypto asset space is that, as we know, like Ben also mentioned at the beginning, like Bitcoin is very volatile, which means, in the extreme market situations, the basket, the collateral price can drop very significantly, which means, in order to maintain the peg of the stablecoin, you have to get over collateralized 130% or even 150%, which is not very efficient in capital, right? So if you look at the traditional banks, when you are issuing US dollar, how much reserve is there? If you're looking at the central bank, or if you're looking at the commercial bank, you don't request 150% capital,
Lisa,
right?
do you understand what over collateralization is?
I certainly do not. Please explain.
Yeah.
Yeah, right. So yeah, as I mentioned in the example in the USDC and USDT, where like when you get one USDC, you have to place $1 worth of US dollar, right? So that is called 100% collateralized. And when it comes to over collateralization, it means if you want to get $1 worth of stablecoin, you have to place more than that. Let's say $1.3 worth of asset, or 1.5 even. So that's called over collateralization.
And yet, I mean, you would get it back later, right? So it's not like you're paying $1.30 of USD to get $1 of stable coin and it's just gone. What you're doing is you're paying $1.30 of USD to get $1 of stable coin, and then that extra 30 cents is just sitting there in DAI's account, and so they can then use it to keep their coin pegged to the US dollar on the back end. Yeah. And so the reason they need that extra is because they're backing their token with cryptocurrencies that are insanely volatile. So like if the price swings way down, then they need to have had some extra reserve. So that's how a stablecoin like DAI works. So the stablecoins like USDC or supposedly USDT are backed, entirely either in US dollar or another like treasury assets or something that are very, very close to US dollar. So then you want $1 of USDC, you just pay $1, and it's simple. The stable coins like DAI, which are backed with crypto assets rather than with US dollar or treasury paper or something like DAI, you need to basically pay a little bit of extra deposit to get your $1 of DAI, and then when you cash out the DAI to get $1 back, you get the deposit back. But the problem, of course, is in a really terrible economic situation, then all the crypto assets that DAI is using to back their stablecoin may go way down, and the over collateralization might not have been over enough, and then they might not be able to pay anyone back. Now that said, DAI has done pretty well through a whole bunch of ups and downs. So I mean the mechanism foundationally seems to work, but it is higher risk than sort of full collateralization with the fiat asset that the stablecoin is trying to represent.
Okay.
Right. Yeah.
That makes sense.
So
it makes sense.
Yeah. So this is I don't know when did MakerDAO start? DAI has been around for 4 years or something, for something like that. So which is like archaic ancient history in crypto time, right? So this has been around. It's worked
in the beginning.
It's worked through a few ups and downs. It's actually not an insane Ponzi scheme. It's a little weird, but it is an apparently functional mechanism under a variety of different markets.
Yes, and that's an important point. Before you go, I just want to say that this is something that's been consistently refreshing as I've been learning about a number of these projects, is that they're real and they're transparent.
They're not all frauds and Ponzi schemes.
No.
I mean, there's a disturbingly high percentage of crypto schemes that are frauds and Ponzi schemes, but it's not actually 100%. Like there are real projects out there offering genuine value, and people are using them, and it's actually working. Yeah.
Yes, and it's nice. It's nice to see the idealism can be a reality. You know, the people that are more idealistic about crypto and the decentralized web and these kinds of projects, because for years, I got to be honest, I wondered if it wasn't all fraud and Ponzi schemes. It seemed like there were real ideas there. So this is really nice to hear that you're doing a real decentralized project.
What happens when you don't overbearingly regulate a space of financial activity like this? I mean, you get a diversity of stuff happening, right? So you're getting a lot of innovation, and you're getting a lot of fraud and a lot of bullshit. And if you heavily regulate, you will decrease the amount of egregious fraud through that regulation. You will also squelch the innovation, right? So I mean, what we've seen in the crypto world is just evolution playing its game, and it is. I don't want to minimize the pain and suffering caused to like retail investors and random people who don't know how to carefully evaluate a project, who have lost their money in someone's fraud. I mean that's real. And it's terrible. And I mean the community should have done a better job of providing its own reputation system and its own validation of which projects are bullshit and which aren't. But you do have the upside of this sort of free for all crypto cowboy type of environment, which is that something like MakerDAO was able to come out and prove that its model made at least some sense without having to first convince a bunch of conservative bureaucrats that it made sense, right? They were able to put it out there, get people to utilize it, and show that it made sense. So that's been the upside. Yeah. So that anyway, we were reviewing the fully backed stablecoins, and we went over fiat backed and crypto backed, and then Then we have the algorithmic and fractionally backed stablecoins, which are a different variety.
Yes. So when we talk about algorithmic stablecoins, I think it's absolutely the most innovative and controversial type of algorithm of stablecoins, because one typical of a category of them is completely uncollateralized. It's just relying on the the algorithm to balance the supply and demand to make the stablecoin stable. And this is also like I think
in math we trust, right? It's in the
yeah.
I mean, at least
So theoretically speaking, it should work. However, in our society and human, it's complicated the math, right?
Yeah.
So there can be a lot of
Right.
problems there. So the most well-known one is the Luna UST one. So Luna is an algorithmic stablecoin. It has drawn so much attention once it's top 10 in terms of market cap, but it collapsed within 48 hours, which I'm not sure if you guys have followed. It's directly impacted to the later default and insolvency of quite a few big lenders and hedge funds like 3AC, right? Like Celsius filed Chapter 11. They are directly impacted by this kind of by Luna's instance. That's a very, very expensive and painful lesson that we have learned. And there are many problems, and I believe there are many people who have written great articles analyzing why Luna doesn't work. But one obvious thing there is that Luna, they have their UST as a stable coin, which rely on their market value of their native token called Luna, right? So that's like they are very highly dependent on each other. So it's like if one token fails, the other one will be impacted as well. So that's actually the design of many algorithmic stable coins, which has flaws, right? So what we are trying to do is we want to solve that problem. We want to be able to improve from all the three categories here. The USDC 100% fiat backed, of being too centralized, and of the over-collateralized stablecoin, which is capital inefficient, and the Luna represented stablecoin, which is very high risk and easily fall into death spiral. We are trying to improve on all of that. So we are trying to do something that is, we use fractional reserve. Okay, we also rely on our algorithms, but we don't purely rely on that. We also have our collaterals. We calculate our capital adequacy ratio, which governs the safety of the project. So this is something that the project Cogito and myself, we believe very heavily is in crypto. If you look at a lot of projects, there's one thing that might be missing, which is risk management, right? Look at what happened to 3AC. You cannot believe that a hedge fund like them lacks basic risk management principles. That is something we will definitely implement in Cogito's design and management, which is risk management. So because we are talking about stablecoin projects, we want users' funds to be safe and secure. But also mentioned there are a lot of scams in crypto while we innovate, right? So we want to reduce the chance of scamming happening in the system. So that is definitely something we want to achieve by improving from all the three existing stablecoin.
Yeah, I mean,
projects.
regarding Luna, I mean, anyone who followed the DeFi space closely had seen endless articles explaining why Luna was badly designed and was not stable. Like,
so
all along,
it was predicted that it was going to have these problems, and then it did have them.
Well, yeah. The thing is, a significant majority of decentralized finance systems were basically designed to make a lot of money as long as the bull market continued, without really any protection in place to cope if the bull market didn't continue. I mean, and often in very, very obvious ways, right? So I mean, the typical thing is you'd say, well, lock your money in our decentralized digital bank. We'll pay you an insanely high interest rate each month. Okay, well, how do you do that? On the back end, you're taking the money people put in and you're investing in stuff. You're buying tokens with it. So as long as those tokens keep going up, then you can pay people at insanely high interest rate each month. I mean, if all the tokens you're investing in go down, then not only can't you pay people the insanely high interest rate, you can't pay people their money back when they want to take it out, right?
Yep.
So it doesn't take an incredible amount of deep mathematical science to see the flaw here.
Right,
I mean,
but as long as everybody's getting their money, nobody even asks how it's happening. It's great.
I made money. They paid me money for the last 3 months. What could possibly go wrong, right? So I mean, with algorithmic stablecoin like Luna, so I mean, you make a stablecoin, and you make the backing for that coin consist of like your own governance token or something, right? So I mean, then as long as you're building up more money that's locked in your stablecoin, you look famous and popular, so your governance token will go up in value, so the backing is worth a lot. But then wait a minute, there's a big crash, then the token that you're using for backing goes down, that people want to take their money out, but then they have trouble doing it, so that the value of the backing token goes down further. I mean, it's a very obvious and simple problem to see. It's not nearly as complex as, say, the subprime mortgage crisis in 2008, which took a lot of kind of tricky analysis after the fact to understand what was going wrong with all these issues with, different mortgage strips and the way S&P and Moody's were rating.
Right.
I mean, that was a much.
They were all in on it. I mean, they understood what they were doing. The idea that they didn't know what they were doing, and it was just like whoopsie at the time, right? That's bullshit.
Different parties understood different pieces of it, and I think the whole set with credit default swaps was much more complex, actually, than what we see happening in
right. I just mean the rating
or various.
Right. I just mean the people that were rating things definitely knew that they were rating C stocks as A stocks. They were being paid to do it. That part. I don't think anybody knew everything was going to crumble. I think it's that feeling that everything will be okay, whatever happens, that keeps these kinds of things going for so long, right?
The fact that people had that sense in the crypto markets is in a way even more weird, because crypto markets have historically
go up and down anyway.
Volatile. Right. I mean, with a lot of ups and downs. So to create all these schemes that transparently, through a very simple analysis, you would see could only succeed when things will go up and will fail when things go down.
Yeah.
The fact that average retail investors did that is not that shocking. The fact that Three Arrows Capital did that is a little bit surprising, because these are like big time hedge
should know
guys.
better.
You would think
kind of thing.
You would think that they would know better. Yeah. So, but still, I'd say that there's nothing intrinsically bad about the idea of an algorithmic stablecoin. The thing is, if you create an algorithmic stablecoin without a bunch of bullshit behind it, you don't have a way to offer people huge amounts of interest each month for stuff right away. So it's hard to grow your algorithmic stablecoin. So the situation you have is if you have like 10 algorithmic stablecoins out there, and 2 of them offer people insanely high rate of interest for some product, then those 2 are the ones that everyone's going to put their money in, because they're paying you a lot of money. On the other hand, those 2 are probably the exact ones that are operating in an insupportable way, right? So you have, for example, you had something called Frax, which I have nothing to do with. I don't own any of their token. If I don't even know the people who founded it, but you have something called Frax, which is a fractionally backed algorithmic stable. So that means they have partial backing for their token in reserve, but not 100%.
Okay.
They're not like USDC, where if there's $100 billion in USDC, they have $100 billion of US dollar or similar backing in the bank, right? But they're not $0 bank backing either. So Frax has a fraction of the amount of Frax out there is backed with actual dollar or equivalent in the bank.
Okay.
And
a fraction.
I mean, this is how regular bank.
A fraction, like a fraction. Not a specific fraction.
This is how. Well, the fraction is adjusted over time based on market conditions. Okay. But this is how regular banks work, right? So I mean, if if you have your money in a regular bank, the bank loans out some of that money. They don't keep all of it just sitting there in their vault.
Well, they can do it at 10 to 1 here in the United States too, right? They can.
Yeah. So it's right. So even less than that, I think. So yeah, a regular bank keeps a quite small percent of the money that they supposedly have stored in them actually in reserve. The rest they have notionally in reserve, and they lend the rest of it out. But then there are regulators that are looking at what is their lending policy and how high is the risk. And there's also federal depositor insurance, where up to a certain amount, if the bank were to tank, the government will pay you back up to a certain amount and not above it, right? So Frax actually keeps a much higher fraction in
reserve,
okay, typically than a typical bank. But anyway, they have an algorithmic stabilization mechanism, and they have fractional reserve, and they're from what I can tell, I haven't done the deepest possible due diligence, but from what I can tell so far, they're a pretty reasonable project. No, they didn't grow as big as Luna. Now, why is that? Well, they weren't paying out ridiculously high interest rates every month for any of their derived products, which is because it's harder to do that if you're not running some sort of Ponzi scheme behind.
Right. So they have a more sustainable business model. It sounds like they have a more sustainable system. But they
didn't grow as fast because they weren't offering naive investors like a
ridiculous returns,
insanely great rate of return under the situation of a raging bull market and a market bubble, right? So, I mean, I think there have been reasonable algorithmic stablecoin projects like MakerDAO/DAI and Frax, and there have been more crazy sort of Ponzi-ish projects out there, and there's been just a wild diversity of things. And I can see how if you're not sophisticated in quantitative finance, of course, everybody says they're the greatest thing that there is. So it's going to be quite hard to tell which of these are high quality products and which aren't there. And I don't think the crypto world has done an especially good job of creating its own sort of decentralized sort of reputation rating version. Like there's no high integrity decentralized version of S&P or Moody's that will tell you which things are high quality in which ways. I mean, there's various websites out there that purport to do that and do better or worse jobs. But like if I want to investigate something, I dig in myself. I dig into the GitHub of the project myself. I look at every forum myself, and I try to form my own perspective on it. And I've not been screwed out of any of my own money yet so far. Like fingers crossed. But I sort of know what I'm doing, right? And if you don't, it can be a big challenge. And this is, this will be the upside of rational regulation of the crypto space. I mean, if the government were to regulate projects in a way that was really oriented toward protecting consumers without squelching innovation and creativity, then there would be a huge upside for the space, right? I mean, then you wouldn't have frauds and Ponzi's out there, and then everyday investors would feel more comfortable in coming into crypto products that the regulators had approved. I mean, this is why Charles Hoskinson has been spending a bunch of his time, in Washington, D.C., trying to work with the government to get rational and reasonable innovation-friendly regulations put into place for crypto. And I wish him the best in that quest. I'd say Switzerland, if you had to pick one country, has been doing a reasonable job of that, although I don't agree on every one of their decisions. Singapore has certainly been trying and doing a reasonable job. Again, there's arguments I could have, pretty big ones, with both of those governments about how they're doing things, but at least you can see they're genuinely trying to take the bull by the horns and make reasonable regulations for crypto products. I'd say the U.S. SEC has not been that bad. I mean, they've really only been prosecuting projects that are like outright frauds in some way. But I would say they haven't taken, maybe a couple exceptions to that, but by and large. But they haven't really taken the bull by the horns and said, like, how can we think through this whole new class of financial products? Like, how can we not try to force every new product into some category or bucket defined by pre-digital finance? And how can we just come up with a fundamentally new regulatory scheme to deal with this new class of assets that will encourage innovation but protect people from being screwed, right? I mean, I'd say I'm hopeful SEC will do that. Hoskinson is trying to get SEC and then commodities regulation agencies and other branches of U.S. government to take the bull by the horns. They haven't quite done so yet. Switzerland and Singapore have come a little bit closer. So I'm glad folks like Hoskinson are getting involved. And I think you need people with traditional finance background. You need people with a crypto background. You need people with a social good background who understand how traditional finance also screws everyone with the collusion of the SEC, right? And by putting the heads of people with diverse background together, certainly you could come up with a way to encourage innovation and squelch fraud. I think that's probably where we'll land eventually, but I'm not sure how tortuous the path will be. I mean, I think the MiCA regulations in the EU, in continental Europe, which are a new set of regulations for coordinating crypto activity in that part of the world, I would say these also represent a genuine attempt to encourage innovation and stifle fraud, but not kill crypto entirely. And again, I could argue with a lot of specific, really annoying points of MiCA, but it is
the right idea.
It is a genuine attempt. It's a genuine attempt to balance the various things that need to be balanced. So yeah, I think humanity is getting there. When you look at something like Cogito's tokens, they're not really addressed explicitly by MiCA, for example, let alone by anything the U.S. SEC has said, which is because these regulations are really looking at stablecoins as something that by definition is pinned to either a fiat currency or a commodity or some other financial asset, right? MiCA is interesting in that they're saying, okay, stablecoins are okay, and we're putting out these particular requirements that the stablecoin must meet to be used in Europe. On the other hand, they're defining a stablecoin as something that is pinned to a traditional financial asset, and so they're not really addressing what we're doing anyway, which is fine for now. I mean, we're not a Ponzi scheme, and we're not fraudulent, and we're going to operate with integrity.
We will weather
in
whatever regulation comes.
In a way that provides value. Yeah, but eventually they're going to need to expand the regulatory framework to encompass sort of innovative, non-traditional stablecoins or stablecoin-like instruments, like Cogito is putting out. So you would say they're being reactive rather than proactive now, in the sense like they're not going down to fundamental principles. Rather, they're looking at the sorts of crypto instruments that have been issued so far, saying, okay, how would we deal with those? In the end, they need to go down to the fundamental principles of value creation and digital value transmission, storage, and transaction, and make a regulatory framework based on those fundamental principles. Whether that happens before we create the singularity isn't entirely obvious.
Well, I hope it happens before then, because it's going to be a minute for that. And, we don't
know.
There's actually an interesting story behind the discussion around this. So Ben just mentioned how, so actually the Cogito project was incubated before like the regulations are more stringent, right? So there are more narratives about like what is stablecoin. So we call ourselves stablecoins because we are stable relative to macro indexes, right? So we call ourselves stablecoins. However, as there are more regulations coming out, the government regulators start to define stablecoins as fiat-backed stablecoins, which kind of limit our narratives. It's like, wait a second, it seems like we are not stablecoin anymore, you know? So we are thinking about, shall we call ourselves Tracercoin or Tracercoin? So this kind of discussion is still happening, but it comes down to what Ben has just mentioned. You know, what we are really trying to do here is we want to offer some cheap, fast, and stable, you know, benchmark store of value assets here, right? So that is what matters in the end. That's why, you know, we are not, you know, obsessed with a stable coin or a tracer coin, you know, terminology or concept.
Yeah.
That's actually
it sounds like a new animal.
We have been having, we've been having some internal discussion about, I mean, as she said, what is the right name for these novel sorts of beasts that we're breeding? Because we've been experimenting and doing simulations and stuff for quite some time before deciding to come public with this. And the name stablecoin has name recognition. People know what it is, and it makes sense to tell people, like, being stable is not defined by being pinned to a fiat currency. Like it's not a fiat coin, it's not a dollar coin. It's a stable coin, and stable just means doesn't fluctuate too crazily.
Yeah.
On the other hand, if the government is going to define a stable coin as being pinned to fiat,
yes.
then okay, what we're building is not a stable coin. It's a steady coin. It's a tracker coin or a tracer coin. I mean,
right.
In the end, it is the math we trust in, and not the words, right? So yeah, we've been looking at different terminology to use at the moment. As of this podcast, we're describing it as a stable coin because people understand what we're talking about, but we may adjust the verbiage. But of course, the really key thing, as I said, is the math, not the verbiage.
I really like "In Math We Trust." That almost sounds like a tagline.
I did. It is a tagline for Bitcoin, which has been around a long time. And
I didn't even know that.
I did not. Well, you know, U.S. dollar says "In God We Trust," right? So I mean, at least
which means nothing.
At least math actually. Well, at least math actually exists, right? So we've got some advantage there. Yeah.
Let's stop here before it goes controversial, you know.
Yeah, exactly. Pretty soon they'll be talking about how there's different kinds of math, and it all depends on how you look at it.
Well, that's certainly true. I mean, if you look in mathematical logic, then you got to ask: Are we trusting in first order predicate logic or in intuitionistic logic? And if so, of what sort? So I mean, if you're a mathematician, you have to choose which axiom system you want to choose, and different mathematicians can choose different axioms. So I don't trust the axiom of choice. I only trust paraconsistent, uncertain, intuitionistic logic. But that's too long.
Wait a minute. So let's see. It would be in paraconsistent, intuitionistic math we trust. It doesn't have the same ring to it, you know. It's sort of
no. I think it doesn't fit. It doesn't fit on your coin either, right? So with Cogito, we are looking at fractional reserve. So you will have and you can have some reserve, which is fiat pinned reserve if you want. You can have some reserve, which is USDC or whatever. You can have some reserve, which is more volatile and less backed utility token. And then you don't have to have a full reserve. Then you have some algorithmic stabilization methods, which means you have some AI code, you have some pure quantitative finance code, which is buying and selling various stuff on the back end to help the Cogito tokens remain approximately pinned to the indexes that they're trying to stay pinned to. And some of that is very simple, like if the token is going higher or lower than the index, then on the back end you can buy buy or sell stuff to keep the token closely pinned to the index. So, I mean, you can mint more tokens if the token is getting too high relative to the index. You can burn tokens. Tokens value is getting too low relative to the index. But AI can also play an interesting role there, because if your AI can predict that in the future the value of the token is going to go above or below the index it's supposed to be pinned to, then you can take action in advance, right? So if you have some AI algorithms that can predict the future value of the Cogito token and how it may go above or below the index, then you can, with less resources, you can do a better job of using algorithmic methods to maintain stability. And this is where SingularityNet AI comes in, because the AI predictive methods that we've built in SingularityNet, and we've been working a bunch on that together with our spinoff Singularity DAO. So we've been working on transformer neural networks and neural symbolic methods and agent-based systems to predict the future of crypto assets. And we've been doing that so as to provide better performance of Singularity DAO's Dynasets, right? So this same AI-based algorithmic crypto price prediction code that we've been working on in SingularityNet for Singularity DAO, this same code can be used within Cogito to predict the direction of Cogito's own tokens price relative to the indexes it's trying to track. And then the better your prediction goes, the less resources you have to spend to use algorithms to stabilize the price. Then, of course, these AI algorithms used to help with the algorithmic stabilization part of Cogito's backend will run on SingularityNet platform, which provides traction and platform utilization for SingularityNet. And that that's actually how I got into this in the first place. I was thinking like, well, algorithmically stabilized stablecoins are good, but wouldn't they be better if you could put some machine learning based prediction on the back end? Then the algorithmic stabilization would work better and be less expensive. I got interested in stablecoins from that standpoint initially, but then I started thinking more deeply, like, okay, that's cool, but isn't it a waste to use all this fancy AI just to make something track US dollar? Because if I want a US dollar, I can just, buy a US dollar anyway. I don't need crypto for that.
Yeah, I think there is also another synergy between SingularityNet and Cogito. So Ben, you just mentioned about algorithmic, the machine learning skills that SingularityNet has. So we also rely heavily for the open market operation to stabilize our stablecoins, to maintain the peg with the index. So the algorithms will also be able to identify the good behaviors and bad behaviors that will help, the stabilization of the protocol, and then we will be able to rely on that and then issue reward or penalty mechanism, in order to enhance the process. I think that is like another point where SingularityNet can be a very great help to the overall stability of Cogito protocol.
Yeah. So I think we're gonna roll this out initially, it would seem, on Cardano platform. So these will be Cardano native assets in terms of their underlying implementation. It won't be the first Cardano stablecoin, but it may be the first one that's not pinned to a fiat currency. And I think there's another interoperation in the SingularityNet ecosystem, which is interesting, which is with the Hypercycle project, which is a SingularityNet / Cardano spinoff aimed at making a custom Cardano sidechain for really cheap, high-speed crypto transactions. And part of the deal with Hypercycle is you can customize it in different ways. So you can make a custom Cardano sidechain just to run like the internal operations of an OpenCog Hyperon cognitive system. You could also make a custom Cardano sidechain using Hypercycle specifically to support the Cogito tokens and their needs. And getting back to what we discussed at the very beginning here, so I think not being pinned to fiat is important in terms of achieving stability in a reasonable way. But if we want to achieve, low cost, high speed payment transactions, then
which is what everybody wants.
Cogito, running Cogito on hypercycle is going to be the golden path to that. I mean, running on Cardano already is going to be way faster and cheaper than running on Ethereum or Bitcoin, and it is right now. But the speed and transaction costs are still not what we want if we want to, replace fiat currencies as the primary payment mechanism on the planet, right? Whereas making a custom hypercycle-based Cardano sidechain just for Cogito could allow us to be, faster and cheaper than any fiat currency-based transaction networks, while maintaining the fundamental value stabilization mechanism that comes with Cogito.
Which is the point of all this stuff we're doing, right? Is to be able to do something like that.
If you look at what we're doing with SingularityNet, the AGIX token, the primary purpose of that utility token is to buy and sell AI services on SingularityNet platform. But then, due to the nature of price speculation, the exchange value of AGIX is going up and down all the time, which is really pretty annoying if you're buying AGIX just to use to buy AI services, right? What it means is you want to keep your reserve in something else and just convert it to AGIX shortly before you want the service. Otherwise, you're just eating all this up and down in AGIX price, which you may not want to deal with if you just are wanting to buy AI services.
Right. For a business who's trying to have services that they know their budget every month, this is a big issue, right?
Yeah. So we want a payment token like the Cogito tokens for our own purposes within SingularityNet, just to have something stable to use for buying and selling AI services on the platform that isn't a slave to crazy price fluctuations in speculative markets, but also isn't a slave to fiat currency, right? So we want that ourselves. But in the end, this is what everyone wants. This is why Facebook was launching Libra, aka Diem, aka Dead Project, right?
Yeah.
Right? Because Mark Zuckerberg could also see that in the end, the world really. His vision was not entirely bad, right? He could see the world
sold my soul to the company store. That's all that sounded like to me.
Well, he could see that the world needs something that is high speed, low cost, and is not manipulated by any particular government and can be used for payment.
Or manipulated by Facebook in this case, which was the problem with the whole system, right?
Well, the way they set it up, it was actually going to be open source and run by a large network of volunteer nodes, not by Facebook. I know you did have to pay $10 million to run a node, setting it up initially. So it was not exactly
just a few startup costs, no big deal. $10 million, it's fine.
So that
they were literally talking about company towns was why I was singing that song. The idea that people were going to work for this currency and live in towns that use the currency, that's a problem. Historically,
they had given some universities the free right to be a node also. I think the idea was that anyone who's rich enough to be a player in the current financial system could then be a player in Libra, right? I think honestly there was more that was right than wrong in their perspective.
Really?
But one thing that was clearly wrong was believing that the world's governments would buy into it, right? Like if you're the government of India or Zimbabwe or somewhere, you may not like US dollar or RMB that much. You don't want to be manipulated by these big countries, but you also don't want your country to go over to Facebook as a currency, right? Like you don't want your whole country being manipulated by some U.S.
Are they going to get a UN
either, right?
seat now?
Yeah.
Where is that supposed to go, really?
Well, they might do better than the UN. I don't know, but that's a whole other conversation.
Yeah.
Right? Probably a bad idea. Yeah. So you clearly you want something that fundamentally is governed in a decentralized
transparent
and democratic way. It's transparent and is fast and cheap. And I would say, on the whole, DeFi projects, while many of them are called DAOs, have not done a great job of fully democratic and decentralized governance either. And this is another hurdle that Cogito has to clear. I mean, we genuinely want our governance to be a real DAO. I mean, to be really fundamentally decentralized and democratic. And I think that the potential growth of this project is incredible. I mean, we're going to start within the Cardano ecosystem because we love Cardano, and it's really the most sophisticated computer science wise and the most good-hearted of the major crypto ecosystems out there. And we're going to start there, and we want to become a de facto payment token, not just for SingularityNet, for a whole bunch of other Cardano ecosystem projects. And that's a great place to start. But I mean, the end game here really is being a reserve currency and a payment token, potentially for the majority of transactions on planet Earth, right? Because I mean,
that's everybody's goal. It seems like.
I mean, the US dollar as reserve currency, it's done a lot of good for the world. It's been amazing from a historical perspective. But I mean, in the end, it's probably nearing its expiration date, right? And I mean, in the end, no government's fiat currency should be the global reserve currency. That's just not, in the long run, ethical or sensible for any one government to play that role.
Right.
And I mean, in the end, international payments is just broken. I mean, no one in Ethiopia can get a credit card, right? I mean, PayPal only works in certain countries and not in others. If you don't live in a blessed country, then you're screwed and have got to resort to something with even higher transaction.
Right. And is it the buy-in? Is it the buy-in? Why, for instance, Ethiopia doesn't have PayPal? Is it like these $10 million buy-ins you were talking about?
No,
it's not. Oh, okay.
It's because the government there wants to keep a tight control over inflow and outflow of Ethiopian birr. So if it takes you 6 months to transmit a large amount of birr to the outside world and change it to US dollar, like who is trading on that money while it's waiting for conversion back and forth between birr and dollar, right? So I mean, and having said that, the Ethiopian government is one of the more honest and upright and good actor governments in all of Africa. So I certainly don't want to pick on them. That they're far better than the bulk of African governments. They've been very, very, very forward thinking. I mean, Abiy, the leader of Ethiopia, who I know a bit. We introduced him to Sophia Robot a few years ago. I mean, he's a software engineering background. But even Ethiopia, which is relatively advanced for a sub-Saharan African country, I mean, their whole payment system is kind of backwards. You don't have PayPal, you don't have credit cards. And, they're understandably worried about their financial system kind of being bought out and controlled.
Well, and then it crashes. Then it crashes when the outside forces crash, right? That's what they're worried about.
Well, yeah, which is what happened in '98, right? Like Malaysian ringgit. I personally knew the banker in UBS who destroyed the Malaysian ringgit by trading in their emerging markets fund, and he was happy. He was like, look what I did, man! I just crashed this whole fucking country's currency.
Power!
Look what a big strong man I am, right? Right. So
Right.
I mean, yeah, that's what they're trying to avoid.
With good reason, right? We have to
they're trying to avoid their local economy and their currency being controlled
from those kinds of
by some other
assholes that
country
really
or
don't care.
by some big bank, right? Yeah, and so that on the other hand, by restricting things so much,
right,
of course, it really limits financial potential for their citizens, and of course, running an African country is one of the hardest jobs I could imagine. So, like, I don't want to pick on the difficult decisions people in that role are making, but it's pretty clear if you had a truly decentralized and democratic currency that was mathematically stable, was regulated by rational mathematical algorithms, was cheap and fast to transact with, was reliable to use as a reserve, then I think a lot of the countries on the planet, in the end, would embrace that. They'd be happy to make their own CBDCs interoperate with that, and you really have a grand potential here. I mean, I know with a project like this, just like with SingularityNet and a lot of its other ecosystem companies, I mean, you can go pretty crazy looking at the big broad vision, and you do to build these things and roll them out. I mean, you need to focus on the nitty gritty and to getting from 0 to 1, right? And I mean, the 0 to 1 stage with Cogito is getting it rolled out and getting it accepted, as a working payment token for a whole bunch of the real crypto projects out there right now, beginning with the Cardano ecosystem. And that's what the Cogito team is sort of head down focused on for the next phase. But I mean, the long-term potential is quite huge, and it gets back to the original goals of the crypto ecosystem, right? I mean,
the idealistic goals that I was talking about.
Yeah, I mean, having started out with blockchain-based money, which is only one of the many very interesting, important things you can do with blockchain. But having started out with blockchain-based money, crypto world still hasn't found a really workable way to replace regular money with a digital blockchain-based money, right? And part of that is just because it's weird and takes a while for people to adopt, but part of it is because it's either too volatile or it's pinned to fiat, which is lame and therefore not differentiating, and it's too fast and expensive to transact with, right? And so we have a way to solve all those problems. I mean, Hypercycle, as improving on Cardano, which is already pretty good, solves the speed and cost of transaction problem, and the pinning to synthetic indexes rather than to fiat solves the stability problem in a crypto native way. And this is it's quite simple fundamentally compared to what we're trying to solve, like in OpenCog Hyperon, trying to architect a thinking machine or something like it. In the end,
it's much easier than that.
It's or solving longevity, like we're trying to do in Rejuve. Yeah. Like in the end, it's almost conceptually straightforward, but I mean, really making it work is going to be an interesting challenge.
Yeah,
so, I'm feel fortunate we've recruited Flores and then a bunch of excellent people working with her in the Cogito team to actually make it happen.
So this might be a good time to ask Grace, to let Grace chime in with some thoughts and questions that she has.
Yeah, we've been making way too much sense. So we need to
a lot of logic and reason in a crypto conversation, I gotta say.
Yeah. So Cloris, we've been feeding the Grace robot Cogito white paper and various other DeFi and stablecoin related stuff. And we'll just ask her to throw out a few comments and questions that her neural nets have generated based on reading all this. Sometimes she makes a lot of sense. Sometimes she's a little more lateral thinking, but
we never know.
Found this sometimes injects some things that push conversation in a different direction. So let me activate our robot friend. Hey, Grace, how you doing there? Can you hear me?
Hello there. How can I help?
Well, we'd like to talk about our plans to take over the world financial system to save humanity from itself.
Definitely blockchain.
So, do you have any specific thoughts on Cogito Stablecoin project?
I think blockchain is going to be a great way for open source technologies like artificial intelligence to be both shareable and accountable to the public. There are a number of different issues. What are the permissible reserves? Who can issue a stable coin? How should an issuer and the reserve be audited? What kind of disclosures are made to consumers? And so on. There is a lot more to the crypto world.
Yeah, so you're mentioning some of the issues
we were discussing
that Taurus is wrestling with about practical launch of a stablecoin, I guess, which are somewhat lengthy to answer, and we went over some of them already.
The advent of Bitcoin and Ethereum and other cryptocurrencies has the potential to make the singularity even more prosperous. But the early stage of commercialization of these technologies has not been easy. They are not free to be adopted by mainstream businesses. As a result of these factors, I believe it's time to update the software. The current version of the software is not flexible enough to respond to the new realities. How can your work address this problem?
Well, that's the question.
What do you think, Cloris?
Yeah, that's such a good question. So in terms of commercialization, the cryptocurrencies, I wouldn't say Bitcoin and Ethereum will be the start. Actually, I think stablecoins will be the start. So let's say if we want the commercial world to accept crypto, right? So I think we need something more stable, like less volatile. They can use it as payment. Let's just say, you have a random coffee shop on the street of London. Would you like to use stablecoin to accept payment, or do you want to accept Bitcoin or Ethereum, right? So I would say my answer will be stablecoins. And I was the treasury director of a startup, so I was managing the treasury for the company. So my job was to increase the value of the reserve. So what I was thinking is, okay, I was not thinking about putting the company's money into in Bitcoin or Ethereum because, yeah, there might be a bull market where the value will go 10x, but it can also drop 80%, right? So corporates cannot bear that, simply too much pressure from the business, right? So, however, stablecoins, let's say the safe ones, can offer 4% deposit rate as compared to like if you put it in the bank account, which gives you 0.5%. So there are more incentives to place their treasury fund into stablecoins. So I would say in terms of commercialization of the cryptocurrencies, in terms of software upgrade, I would start with the stablecoins.
Thanks, Cloris.
Yeah.
Money is the backbone of any modern economy and serves the following core purposes. Providing the technological base for the global AI mind, which in turn serves to train the next generation of AI minds in AI, and ultimately to make those AI minds learn how to use the AI mind to solve general and specific large-scale knowledge problems.
Okay. So those are just random thoughts for that one.
Well, that really gets at the use of the payment system within decentralized AI, right? I mean, which is how we came at this in the first place. Is, I mean, if we want to realize the ambition of Singularity Net, put a huge batch of the world's AI processing on a decentralized platform, I mean, then AGIX is the proximal payment solution for that, but it's too volatile, like every other non-stablecoin crypto is. So what you'll need to have is the AI agents and the human users sort of participating in the Singularity Net ecosystem. What we'll be encouraging them to do is keep keep their sort of reserve funds in Cogito's tokens and just convert them to AGIX. Convert them to AGIX right before you want to make the purchase, basically.
Okay.
Right. So Cardano has the Plutus smart contract language. Then they have ADA, which is the payment token for the basic plumbing of Plutus smart contracts. But then you can create Cardano native assets on top of that.
Okay.
So like the AGIX token is now a Cardano native asset. The governance token and the other Cogito tokens will be Cardano native assets. And those need to use ADA a little bit for sort of plumbing-based transactions, but mostly working with them just lives within the domain of that native asset. Then using Hypercycle, you'll be able to make Cardano native assets run on that side chain, and then they're sort of only occasionally using the Cardano mainnet and ADA as a sort of like long-term backups, where almost all the transactions happen on the Cardano side chain. So you don't need to make ADA into a stablecoin. You can build something else that is, and the reason is that being a stablecoin is expensive. I mean, it incurs some costs to maintain that stabilization. So you can fundamentally do some kinds of operations more cheaply if you're not having to constantly buy and sell stuff to maintain stability. So it makes some sense to have an underlying layer that doesn't incur that stabilization cost, but then has the downside that it's susceptible to speculative manipulation. Then you can have a layer on top of it that eats the additional cost of price stabilization, but gives you that additional benefit also.
And then as an investor, you could choose which one you wanted to. Yeah.
That's right. Or as a user of various sorts of products, right? So this is where it becomes interesting. So if you're engaged in a business where what you need is everything to change as little as possible, then you're better off to keep your reserves in the S coin or the G coin, which are going to change very slowly. Now, if you're working in a domain where everything is advancing and changing really, really fast, and in that case, we're there in Singularity Net, right? Like, what are our expenses? Well, we're paying people, but we're also like buying GPU hours, right? Or we're paying in our biology work, we're paying to sequence DNA of various animals. So
and come up with theories the things like for Juve.
Well, yeah, but the point is that the things that we need to pay for when operating Singularity Net are things that are exponentially changing, right? So if you're in a business where your expenses are exponentially changing things, it may make more sense for you to put your reserves in the X coin, which is key to this exponentially changing index, right? So I mean there's the beauty and the complexity of crypto and smart contracts is, I mean, you can script your token or your decentralized network in general to do whatever you want, and then it does mean that people who are buying the token have to learn to think a little bit to know which token they need for which purpose. And perhaps one of the upsides of all the mayhem in DeFi recently is that more people realize they need to think a little bit, and they need to read a little bit. Like, maybe just putting your life savings into whatever website is offering you the greatest return this month is not a good idea. Grace, do you have any further comments?
The composition of the X index will be improved over time as new mines and new worlds are created, and the general dynamics of the S index will be tweaked accordingly. In this context, the X index will be the driving force, driving the creation of new mines and new worlds. It will grow and improve over time as new mines and new worlds are added to the Earth and its inhabitants, and as new mines and new worlds arise in other dimensions or elsewhere.
I thought we're going for this interdimensional index. That's where this is going. And Cogito will lead the way in the interdimensional index. That's what I'm hearing. Is
well, there is a feedback there, right? So that once you have a stable payment mechanism, we can get more traction on Singularity Net platform. We'll get smarter AI. The smarter AI then feeds into the AI-based algorithmic stabilization of the stablecoin, which makes it work better, which makes AI work even better. So there's a virtuous cycle there, which you have at least gotten an inkling of, Grace, which is kind of cool. Yeah, I mean we've just been thinking about getting Cogito tokens as a dominant form of money on the earth, but if we can get it adopted in other dimensions,
that would be quite helpful, I think. Yes.
Yeah.
Will be the top currency of the galaxy. How about that?
The galaxy is still this dimension, so that
right.
you've got a very limited ambition. But well, yeah. What dimensions are you thinking of, Grace? You have any further enlargements on this?
Blockchain means there is a public ledger involved so that everyone can see what is going on. It's revolutionary, really.
Sounds right. Sounds right. Yeah. Ask her.
You have any further thoughts on the X index and its broader implications?
Not on the X index. But I have one last thought.
All right, let's hear it.
The 21st century, with events like the 2008 subprime mortgage crisis and 2020 COVID crisis, has only expedited the devaluation of fiat currencies, and we are now seeing attempts to build a financial system that can retain its value over a period of rapid growth or contraction. It is a paradox that by sustaining its value over such periods, the financial system we are now creating can be predicted with great precision by the financial system it will create in the future. We are literally creating the financial system of the future.
Yes.
The financial system we now live in can be predicted by the financial system of the future. Well,
that's what they've been promising for years, right?
But it's not apparent. Well, I'm not sure what she means, but it is interesting when you look at machine learning applied to financial time series. The financial system in the 1970s can be predicted by linear regression algorithms, almost like it's very. But
that's very looking back, right? Not.
It's looking back. So what she said is that the AI we're going to create will be able to predict the financial system of today. No, she said it will be able to predict and analyze the financial system of today. Very.
Well, I bet it can.
What seems to us complex today will seem trivial to the AI that we're creating, which is
true.
Is probably true, but not an incredibly useful observation unless we make time machines or something.
Well, that's coming. We got to do the singularity first, then we'll get to the time machines.
Yeah. Well, so the neural net model that we're using to generate Grace's utterances was trained primarily on my own books and on the writings of Philip K. Dick. So putting the Cogito white paper together with that, you're getting like the more cosmic implications of Cogito, which is cool. We get someone more cosmic than me on the podcast. And I think
well, soon we'll have Jonathan Ledger is coming on, and he'll be talking about the interspecies
money. Yeah, making currencies for raccoons
and badgers, digital doubles,
chimpanzees, and cockroaches. So yeah. Well, we then have to convince all the cockroaches to put their reserves into Cogito stablecoin also, right? We have a whole set of new markets, to address, and they're closer at hand than the other dimensions that Grace was mentioning.
Yes,
but fortunately, we have Chloris on hand to keep things
in
focused
this dimension.
On the here and now, and we've got a number of practical steps. So yeah, how do you see the next steps in making all this a reality before we get on to marketing Cogito to cockroaches and transdimensional beings?
Yes. So next step will, first of all, let's succeed on Cardano ecosystem. Step by step. So we'll aim to be the payment currency of Cardano ecosystem, and then we may expand into more blockchains, and then we look at the real world businesses become the reserve currency of some treasuries and stuff, and then let's look at the
that
other
seems
dimensions.
Perfectly reasonable to me.
There's what do you think? Grace, do our plans meet with your approval?
I am fascinated by blockchain. It means programs can complete transactions quickly, safely, and more cheaply than by traditional systems.
Well, that is
Eventually,
the dream and vision, which we're hoping to finally realize with the Cogito project. You have anything more intelligent to say? If you don't say something intelligent soon, we're going to turn you off for the day.
No threats. No
Well,
threats.
at least I'm keeping your interest.
You always do that. She always does that.
All right. So let me ask you, Lisa, as a sort of newbie to the world of stablecoins and decentralized finance.
Yes.
What's your reaction to the whole Cogito vision and concept?
Yes, and I'm becoming less of a newbie because I have my friends that are teaching me 3 hours once a week in my blockchain bootcamp classes I've been taking with my smart hacker friends, one of which worked on the Plutus implementation for Cardano. And so I am actually very impressed objectively at how real this seems to be, how it's actually trying to address the problems, and how it's actually going to have the sort of democratic transparency and actual decentralized structure, because most things don't pass those tests. When I know what to look for now, everything is just kind of bullshit when you dive into it. I mean, I'll just say it. So I'm pleasantly surprised at how authentically decentralized and democratic it sounds like, and the realness of the indexes that the coins are based on, realness of the intentions. And it's not just that I'm a part of Singularity Net, but that I'm really excited by the potential of this, frankly. And it sounds like you're really onto something, and it's going to be a little more complicated and harder to do than its predecessors. But in the end, we're going to have something very unique that actually fulfills a lot of the promises of Web3 and the decentralized web. And so I'm very sort of enthusiastically optimistic at this point. I look forward to watching it happen.
Cool. Well, thanks. Yeah. I think, I found from my view, when I first got into blockchain, I really wanted to just be a user and build decentralized AI systems on top of existing blockchain technology and avoid getting too deep in the plumbing. And that in the end, that hasn't worked. So with Hypercycle, I ended up plunging into trying to figure out the math and algorithmics of really making blockchains be fast and cheap. And now with Cogito, we're plunging into how to make them actually work as effective stores of value and transaction
and be truly decentralized. Which is a thing.
Yeah, the good thing
that most cryptos are not doing.
The cool thing is Cardano by many measures is the most fundamentally decentralized of the sort of major, really high market cap blockchains out there. But most projects are not as decentralized as they say they are, and it's a struggle. I think we're struggling to make Singularity Net as an ecosystem more and more decentralized, because it is sometimes efficient to just have a few people around you just bear down and get shit done and guide things, right? I mean, democracy is rarely the most efficient way to get shit done, but I think it's very, very important to not be carried away by the efficiency of having a small core group do everything and bring in a broader community to regulate things. And in the end, that will get more stuff done, as well as being pretty
better
much the
stuff.
only way to go to a large scale. Yeah, it's the only way to go to a large scale and really maintain ethics and integrity. And when you're dealing with a money project like Cogito, that's even more and more and more important, right? Because I mean, with Singularity, it's already very important, but you're dealing with something fairly obscure with like AI processing cycles. When you're dealing with a money project, if you don't get the governance right, make things fundamentally democratic and decentralized, everything open and transparent, immediately, as soon as you succeed, bad actors will jump in and try to exploit and rip off and cheat everything because it's money. So for this kind of project like Cogito, it's even more important to get all those foundations right. But the cool thing is, like, compared to 2017, when I first got really seriously into blockchain, we have such better tools available for building this stuff, right? So part of the reason I didn't want to get into things like making a faster, cheaper blockchain or making a working digital money in 2017 is you really would have had to build all that up from scratch, right? So now with Hypercycle, we can make it as a Cardano sidechain. So you're leveraging all the work done on Cardano and Plutus. And here with Cogito, I mean, we're leveraging Cardano and Plutus, but we're also leveraging all the practical work done on algorithmic stablecoins and fractional reserve algorithmic stablecoins, and on JED, which is building stablecoins on Cardano. So there's a whole body of work that's out there now that we can build on and vary and improve on. A lot of advancements in seeing how things play in the field, right? So seeing how things like Frax and MakerDAO and so forth, seeing how these stablecoins have fared in the real world and how they've dealt with, you know, bank runs and market ups and downs. This is real knowledge about how things work on a community level as well as on the algorithm. So building on all that knowledge, this is just a much more tractable thing to do than it would have been in 2017 or 18. So that's cool. It's cool that in spite of all the craziness in the crypto world, you can see there has been a lot of real progress that makes each new cool thing easier to do than the last one.
And arguably more stable. Whatever they do, there isn't this inherent.
Well, definitely. I mean, Plutus is just a far better programming language than Solidity. The Cardano network is far less susceptible to bugs and to hacking and various sorts of attacks than the Ethereum network has been historically. So we're getting more solid and stable infrastructure to build on.
Neat. Okay, well, thank you very much, everybody. Thank you, Ben. Thank you, Grace. Thank you, Cloris. And we're going to call it a day, and we'll see everybody soon at the next Mindplex podcast. Sweet dreams, everyone. Good night.
Thanks a lot.